Welcome. Today we are going to talk about the various sources through which you get stock recommendations and which one is the best for you, right? So if we can broadly classify the various channels through which you get stock recommendations, and I'm not including the own research that you do, right? We will leave that aside. We can classify broadly, three kinds of channels through which you get recommendations. One, and which is very popular, is the brokerage reports, the institutional brokerage reports and the retail brokerage reports that brokerages come out with. The second one is the stock recommendations that you constantly see on media, which is the traditional media like newspapers and magazines and so on, or the social media online through Twitter and Instagram and YouTube and so on and so forth. The third classification would be the paid services, where you pay to get research recommendations or advice. Now let's look at the pros and cons of all of these and try and decide which is it that you can go for optimal quality recommendations in an unbiased manner. So let's take the brokerage reports first. Brokerage reports broadly are classified into institutional reports and retail reports. The institutionals are much more in detail because they cater to institutions. But the fact is that their coverage universe is limited, which means they cover mostly the large and the mid to large, which are already quite discovered stocks, right? So for a retail investor looking for multi-baggers and so on, you probably won't get the kind of stocks that you're looking for. The retail reports likely will have a little more aggressive companies, the smaller ones, that retail investors like to look upon. Now, what is the underlying philosophy behind these reports? These reports are to aid you to action, that is to transact. In a brokerage, it is your transaction that delivers them the fee, right? So if you see many of these reports, they come with a target price. Almost always you will have a target price, and most of them will last few weeks to few months. I probably know of just one or two brokerages where they even take more than a year's call, right? So why is this? This is because it aids them to churn your portfolio. The shorter the duration of these calls, the faster the churn, the more you transact. If you actually record the kind of calls that are given and see if those stock move up after such target date, many may have, right? And the reverse is also true, that where they cut losses, they may still deliver. That's a different thing. But the fact is this: the short-term nature of these calls and the requirement, the nature of churning those portfolios essentially means that these are not really meant to be primary recommendations and advisory solutions for you. They are just ancillary. A brokerage is there to provide you a platform to transact. One of the things that they do is provide these recommendations for you so as to aid transactions. Please keep that in mind. So it is for that purpose that these reports are really in existence, especially for retail investors. So you should understand this clearly. The second thing we will talk about is media and social media. When it comes to media, the traditional media, many of them have very good reporting system. Many of them cover companies in depth and all. But please look at whether there is any onus, any responsibility on their part to follow up on these calls that they give or take onus for those calls. None, because they are not regulated. They are not regulated under SEBI. They are free to write on any company, give recommendation and move on, right? So that means you don't know what to do, when to do, etc. Nobody is going to really advise you on those. Another thing you need to understand is they are not free of conflicts. Many of these newspapers and magazines thrive by taking advertisements. So, when they come up with IPOs, there's also an ad of an IPO. There are companies that publish their financial results regularly in these traditional media, So all of these clearly creates a conflict of interest. So although you might think it's very cheap advice, you pay 10 rupee, for a personal finance newspaper or a 40 rupee for a magazine and get these. Please know, one, that there is no onus, it's not regulated, and two, there is a conflict of interest. The more a kind of riskier channel is the social media channel. There, at least the newspapers, You don't know they exist, who they are, etc. In social media, you don't even know oftentimes who is giving these calls, why they are recommending, why are they so benevolent with a money making idea so as to let you know their secret and let the world make money. After all, in stocks, money is made only when information is limited or closed to certain groups, when everybody knows there is no money to be made, right? So why is it that they are doing so? It could be that they are pump and dump investors who basically buy, give out a call, allow others to buy, and then dump those stocks, and you're never going to know when the stocks are dumped. That's one thing. The other thing is agenda driven, right? They might be getting paid for what they're doing. There are plenty of influencers, etc., who do this for a living, right? And very importantly, here again, none of them are regulated. So that's something that you should be very clearly aware. There are no free lunches here. The other, kind of very often followed, kind of recommendation is from star investors, very large investors who come out saying, their portfolio is all out in the public, where they have invested in, and you try to mimic them. But please remember this, their risk, their own portfolio's setup is not known to you. And you do not know when they entered. You do not know how they built positions. And very importantly, you do not know when they exit, when they take wrong calls. Let's take the case of the great late Sri Rakesh Jhunjhunwala. He had made brilliant investments, but you don't know the kind of positions he built. And very importantly, you don't know when he cut his positions. For example, he made calls in stocks such as DHFL and India Bulls Real Estate when they had really fallen after all the troubles that they had, and he took positions in them. But when he realized that those calls were not working, he quickly cut. He cut his losses. He knew you had a loss. He cut his losses. Now these are the signs of a great investor, right? And you never know much about that side of the greatness, the risk mitigation side, the size position building side, none of those that you are aware of. So to blindly think that I will follow a star investor does not work. So you, while the mere social media following is quite lethal, the star investor following you cannot expect that you will mimic and make returns, right? So, and very importantly, again, none of these, when they give out, there's no regulation. Nobody's going to come out and tell you, hey, cut your losses here, or, build positions here. So you need to be aware of that. That leaves you the third option, which is paid recommendations. Now, there's a good and bad side, difficult side to paid recommendations. Paid recommendations obviously are regulated. They take onus. When I say paid recommendations, please remember these are not the guaranteed returns that come out there for F&O, 18% annual returns guaranteed. No, they are not regulated. Please remember they are highly risky, and there are people who have lost money, as you would have read on many of the social media channels. I'm talking of the regulated ones, whether it's the research analyst, your RIA, registered investment advisor, your PMS, and so on. Now this is serious business. People take your money and either manage them, or they take a fee and give you recommendations. And there are, very importantly, follow-ups on those recommendations, right? So at least somebody is taking the responsibility of giving those. But the important thing is to identify whether they have a good track record, right? And whether their strategy or style suits you. For example, some of them might just go for a lot of momentum, right? Do you want momentum, or do you want a long-term portfolio to hold on to? Do you want high churn, which can constantly, involve buy and sell and increase your tax incidence? Or do you simply want to stick on to a portfolio, a coffee can like approach where you can hold for the long term, maybe build positions over time, right? So these are little difficult decisions, but the biggest positive factor too is that you can actually rely upon the regulator to help you if there are issues in the last option that I mentioned. So therefore, to my mind, the best stock recommendations, there are no free lunches. The best stock recommendations come from paid sources without any doubt, irrespective of what we do or what we don't do. We can definitely tell you, kind of trying to build a very serious, large sum of portfolio with quick tips does not work. So look at any option. I mean, you can go for the ones, You can, something, like small cases where you have a lot of things to explore, or you can look at individual platforms like ours where we don't take any kickbacks or advertisements or commissions. So look at the intent behind who is operating and whether they are doing this solely for your benefit. They take a fee from you and do it for your benefit. And the incidental, benefit for them could be that you are paying them the fee, but it cannot be just, kind of a hidden agenda there. So make sure it's not there, and wish you all the best. Do let us know how your experience was by commenting here. Do subscribe to our channel so that you will have more inputs across various products. Thank you.